Okay, so we're showing this wedge here because that ABC can surprise us. So we have a 3 and we have a 4 here. So A and a B and an A and a B and a C. This is level 4. We know this is a level 5 and that is a 3-5. Okay, so now we understand that if the market cannot move out of that wedge, that this A and the B and C that you think is going to go all the way to 152.8, the market is going to trick you and it's just going to do an A and a B and a C and then go down, and it's a new downtrend. All right, so we don't want to just believe that the best of technical analysis has to work out and have a higher correction all the way to 152.8 because the fundamentals are not there. Money is going out of all stock markets, so how can sterling rise against the yen? Probably not. Okay, so this means that if we get a degree 3 trigger on the 15-minute chart, once this becomes negative again and we get a degree 3, we go short full size at these lower levels, 100 and maybe it will be 151.4, 151 even. We're seeing some kind of a double head and shoulders. We draw a neckline here, the market moves down. Our stop is just above the head, 152.3. We adjust. All right, at that point, this means we go on a momentum confirmation. This is also why we would want to have feelers, so we can start having feelers as of that level, 152.25, 152.45, 152.8, because we can just get a spike out of this wedge, and the market is doing a shoulder, did a bit of a higher head at 152.45. That is it, rejects, and that becomes wave C. Anything can happen that is bearish, and we have to really focus on this. That's why we're doing the monitoring in the first place. It doesn't have to be that we'll get the levels that we want. It doesn't have to be that we'll go all the way up to 153.36. As a matter of fact, I doubt it because of the fundamentals, but it can happen. So we do that monitor very, very sharply, all right, on the belief that an A and a B and a C can end at 152.45, can end at 153.4. all right, so we'll have feelers again at each of these internal smaller levels, 152.25, 152.45, 152.8, and of course 153.3. all right, but more importantly is to monitor the momentum plot. If this is an intra-week trade, very important to get in at the right level, full size, if you really want to do the right equity. So it's very important to get in the right level, full size with as minimum risk as possible, all right, and go to that target where we're gonna make an engineered equity that is equitable to our account, something like whatever 10% on a weekly basis, maybe less. All right, so it's just important to focus on 1 or 2 trades and do them right and have a good bulk, a good even risk on that trade of 3 to 5% should be okay, and will get you a yield of 7, 10%, even maybe 15%. Remember, this is just a weekly trade. So this means that if we get a rejection at 152, for instance, 0.45, and we get to identify that we have degree 3 momentum on that, we can have now a momentum top out on the 15 minutes. You simply bring down your entry down here. At that point, you're seeing really local heads and shoulders. Everybody can see these heads and shoulders. Suppose I get negative momentum right now. This is an entry. Negative degree 3 on the 5 minutes. And this is the top out, and I have negative degree 3 on the 5 minutes. This is really an entry. There's no problem with it. And I would just make that entry at, say, 151.3. At that point, I'm seeing, of course, heads, and we had some kind of a wedge or a higher head. I'm seeing heads and shoulders. This becomes my hedging zone. I'm not going to use stops. I don't want to lose money, so I'm not going to use stops. So I'm going to be shorting 151.3. I'm going to be hedging at 152.3 or 25. This means I'm using a 100-point hedge. If I want to risk $500, it's only half a standard. If I want to risk $750, it's only 7.5 minis, all right, so on. And I take this, of course, to these profit targets that I'm looking at. If I want to close out before the end of the week, or towards the weekend, I'm looking at 150. Should be easily seen 127.2, if maybe even 138.2, 149.5. All right, until then I get that negative momentum plot, I will of course stay put and consider that I'm really going to be taking the best, which is that 50% here entry and 38.2% second entry, half size, half size. This is too academic, probably will not fill, but you never know, maybe it's our good day fortune and we get these fills at these levels, and there is that hedge all the way up, that hedge or that stop if we're not there on the platform at 154.8. Could take it down a bit to 154.8, just 154.8. So I'm always we expect that we are momentum traders. We want to go with the flow. Flow equals momentum, and you must have two momentum cycles in confluence with your trades. So if we get a degree 3, now we have a good strong momentum cycle in confluence with your trade. If you get a degree, this is a 5-minute chart. If you get a degree 3 on that 5-minute chart, we don't yet. A degree 3 would look something like this. This is a degree 3. So 1, 2, internally 1, 2, 3, 4, and a 5. This is a degree 3. You can see that gives you latitude to get into the trade, and by the time you hit the market bottom, if the market rises against you, so this is a degree 3, it just corrected until the bottom of level 1. Right, so even if the market rises against you, you're not really losing money. You're right at where you've entered, provided that you have negative momentum on the 15-minute chart. You have either degree 3 or a degree 1 on the 15-minute chart. Of course, we are now at breakout point, so we're looking at a degree 1 on the 15-minute chart. So let's investigate this. We have that line here. This is a degree 3. Let's take a look at what it was looking like on the 15 minutes. And you, at that point, of course, had a degree 3 on the 15 minutes. So definitely the market goes down. Right now, we're not going to have the same scenario. We are having a positive plot on the 15 minutes. We are having a positive plot on the 5 minutes. Okay, so we just need a degree 3 on the 5 minutes and a degree 1 on the 15 minutes means, because we are on top out, that there is negative momentum on the 15 minutes or something that is below 0. Usually, if you have a degree 3 on the 5 minutes, degree 3 on the 5 again means CCI is below oversold. A degree 1 here on the 15 would have CCI just above oversold or trying to attack oversold. Then the market is a go, the market is a short, right? And the market will try, for reasons that are unclear to me, the market will try to show you that it's going to be doing an inverted head and shoulders, going to be correcting higher. You will be surprised to see actually the reverse of the pattern breakout. You're having a wedge, and actually wedges also should be breaking out higher. If you have this kind of wedge, it's a bullish formation. You could do lower lows, but you should be breaking higher. But you'll be surprised to find that the market is going to be using this wedge, okay, to go all the way to these very lower levels, S2, 150, and then even maybe lower, S3, 149.50. And of course, it's better to be on the right side of the floor or on the right side of the momentum trigger.